welcome to this Diwali special edition of Money, Money, Money. As you can see, we're not in the studios today. We are here at Palladium High Street Phoenix in Mumbai, and we're here to soak in the festive fervor, the spirit. Every year at this time, we invoke her blessings, we worship her, and we strive to have her presence in our lives. Yes, I am talking about the goddess of wealth, goddess Lakshmi. Now, prayers and divine blessings definitely have their role, they have their part, but perhaps a little bit of intelligence and some patience can also go a long, long way in ensuring that your money works for you. So we are here with a very basic question. Will somewhat 2073 be a wealth generating year? And if yes, then where should you be putting your money? Which are the asset classes to be in? To help us understand all of that and more, I have a panel of experts right here with me. So let me quickly introduce them. We have Ashish Shankar of Motilal, Oswal. He's the head of investment advisory at the private wealth management services. Ashish, good to have you on the show. And someone who needs absolutely no introduction. He's a veteran with the capital markets. Nilesh Shah of Kotak Mahindra AMC. Nilesh, pleasure to have you. Thank you so much for sparing the time. An old friend of Money, 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 Gaurav Mashruwala, who's a financial planning expert. And how are HNIs looking at their wealth management this year? Well, we have Prateek joining in from Sanctum to answer that question. Gentlemen, thank you so much for joining in. I'll start with the basic thoughts. Nilesh, your thoughts. Will this new coming year be a wealth generating year, you think? Looking at the macros, looking at where India is today.
Sure. So making money is always simple, but it's not easy. So this year also will be like past years. The guys who are disciplined, guys who can take risk, they'll make money. The guys who want to just copy past performance, they probably will fail.
So that's a statement. Making money is simple but it's not easy. Would you care to elaborate a little bit on that?
Sure. So all of us know that if you jog, your physical health will be good. If you avoid junk food, your physical health will be good. But we end up eating junk food and avoiding jog, and then we complain that my health is not good. The same principle goes into the financial side. Everyone knows you have to have asset allocation, you have to have systematic investment plan, you have to have long-term investment. But the problem is that no one is able to follow it, and then they remain poor. So making money is very simple, provided you have long-term investment horizon, provided you do regular investment, and provided you maintain balance between greed and fear, between various asset classes, you will make money.
But we keep hearing a lot of experts, of course, talk about the macros and whether overall the economy looks like, it'll help people generate more wealth this year. So what are your thoughts there?
If we don't create that facade, we won't have a job. So we need to make life complicated for people so that experts like us will be required. But yes, the markets are complex. It's not easy. We are a global market, so we get influenced by US presidential election, US Fed rate hike, European Union banking crisis, China, and maybe some more things which I can't imagine. But at the end of the day, what we have to ensure is that we buy what is cheap and we sell what is expensive. And if you do it consistently, it's very easy to make money.
Okay, he makes it sound so simple, doesn't he? Well, we'll come back and we'll talk more about that in just a bit. But Ashish, your thoughts? I mean, overall, looking at the picture around us, do you get the sense that the next 12 months will be prosperous?
So, this year's been quite testing for most investors. We saw the market coming off their highs, hitting lows towards the beginning of the calendar year. And here we are again closer to the all-time highs.
Exactly. From February onwards, it's been a phenomenal run for the equity market.
So, it's been quite a ride in equities. However, I would tend to agree with Nilesh Bhai. I think people who keep their eye on the longer term picture will create tremendous wealth. I still believe that to be in equities, first you need to be an optimist. And if you're optimistic about the future of this country, I think there is a lot of wealth to be created. We haven't seen anything yet. But yes, we are living in a globally coordinated world. And like they say, if America sneezes, the world catches a cold. So we will get affected, from time to time by global events. But I am an optimist, and I think the best is ahead of us.
Okay, all right. Very quickly, your thoughts on this as well, Prateek?
So it's, we are coming on the backdrop of a fairly decent year. I wouldn't say a spectacular year, but you pretty much have had all asset classes do well, whether it was debt, equity, or even gold. Maintaining this type of momentum going forward in our assessment is going to be a challenge in the near term. Well, there is a long-term wealth creation story, and the compounding effect always works in creating long-term wealth. There are going to be some external factors in play, which Nilesh was alluding to. Domestically also, when you are at these stretched valuations, historically we've seen that it's not been easy to generate significant returns in an equity asset class when you invest in the index.
Before I come down to some of the specifics and the points that Prateek raised, Gaurav, your thoughts. Overall, do you think your clients are going to make more money this year?
So yes, I mean, as long as you look at your own economic parameters and not too much worry, because, for example, look at your own GDP numbers, and which is goals and dreams plan. Look at your IIP numbers, investment and income plan. Ensure that you stop paying EMI and start investing in EMI. So stop paying your equity and monthly installments, get out of loan, and start your EMI equity monthly investments. Conduct your AGM and quarterly reports so that you're sharing the information with your family. Look at your WPI. I mean, what are your wealth passing on instruments? Is will in place? Is nomination in place? Who's your CEO? Your contingency and emergency options. The moment you keep looking at your own economic parameters regularly, you will create wealth. What happens is...
You've given us a lot of acronyms, so WPI, IIP, all of those terms have turned around. I'm going to come back to that and go over the specifics in just a bit. But Nilesh, some of the thoughts that just came through, the talk about valuations, whether the market is looking a little overheated. Should you be buying now, or is an SIP the way to go? Should you be doing lump sum? These are the questions that are typically always there on our retail investors' mind as well. What would you advise looking at the current scenario?
So in Ramayana days, we had Kumbhakarna, and if Ravan had a mutual fund NAV, I'm sure Kumbhakarna would have woken up without just looking at that NAV statement. So if you are going to be like Kumbhakarna, who can sleep over investment for 14 years, certainly go and do lump sum investment. But do lump sum in equity, not in liquid fund.
Okay.
Second thing is that if you are unlikely to be Kumbhakarna, then why don't just go for SIP? We do it for our physical health. We eat breakfast, lunch and dinner. We don't eat at one go for 7 days. If you can't do it for your physical health, you can't do it for financial health as well. So do SIP, that's the best way. And as Ashish was mentioning, we are at that stage in market and economy where things are falling in place. Monsoon has been good. Interest rates have started coming down at borrower level. Liquidity in economy is going up. Foreign direct investment is flowing in. The festival season demand has been fairly solid. As we are seeing here, lots of consumers moving around. So overall, the economy will do well. And when the tide rises, all the boats automatically gets lifted. You should be staying in the boat. You should be sitting in the boat. That's it, what is required.
Okay, so we're going to take a break and discuss some more details about this boat. How should your boat be? Should it be a large boat, small boat? And SIP is already the way to go that you've already explained. So some more about equity investing and some thoughts you can keep in mind for the next 12 months coming up right after the break. Welcome back. Here with the Diwali special edition of Money, Money, Money. We are in conversation with a panel of experts to figure out where can you invest to maximize your wealth in summer 2073. So we've been talking about equity. And Nilesh, I want to get back to the conversation. SIP is the right way to go. But then the questions always come in mind. In a portfolio right now, looking at the market environment, should you be having a higher concentration of large cap funds? What's the right mix between mid cap, small cap, large cap, and that whole search for alpha, so-called alpha generation in your portfolio? How to go about it?
So currently, my feeling is that over next 12 to 18 months, small caps will give better outperformance compared to large or mid. And the large and mid gap will be very narrow. Maybe large cap will outperform a little bit, maybe mid cap will outperform a little bit. So the best way will be if people can invest into multi-cap portfolio and allow the fund manager to choose the allocation between large, mid and small. If you are very conservative, then maybe large caps will be more suitable. If you are very aggressive, then small and mid caps will be more suitable. But if you don't want to take any chances, then a multi-cap portfolio will be far better.
Okay, what are your caveats or what are your thumb rules for investing in a small cap fund? Because that's where the degree of risk is also higher. Obviously, hopefully higher returns as well. But what should one keep in mind?
So in this small cap business, you need to be aware that you are going to get some failure. it's impossible for you to predict future. So don't invest in just one or two small cap and hope that they will become large cap. Buy into a portfolio of small cap, preferably a fund if you don't have that kind of money. And then whichever small cap keeps on doing better in terms of performance, you keep on adding more of that. Hopefully that will allow you to transit from a small cap to mid cap and mid cap to large cap, making lots of money. But don't be that illusion that I will pick up a small cap which will eventually become a large cap. That doesn't happen that way.
Ashish, your thoughts on generating more out of your equity portfolio? So what's your sense?
So if you look at the way markets have behaved over the last year or so, the mid caps as a basket are showing a bit of overvaluation. I mean, expectations clearly are, running ahead of prices. So if, let's say, the earnings don't revive for a lot of these mid cap names, you could have a sharp fall in prices. So our views, it's a good time to give money to managers in multi-cap formats, because it's best for them to decide, whether they want to allocate to large caps, mid caps, or small caps. Further, although we are very optimistic from a 2 to 3 year perspective, I think in the near term there are several, events and headwinds, and that could create volatility in markets. So it's not a bad idea at this point in time to stagger your investments into equities.
Okay.
So that's what,
I mean, the SIP approach, which is what Nilesh was just talking
SIP
about.
approach, or for HNIs who already have capital with them. I mean, for salaried investors, who get regular cash flows, the SIP approach will work. But for, let's say, HNIs or ultra HNIs who already have capital with them, for them maybe an STP over the next 3 to 6 months will work extremely well.
Okay. Pratik, speaking of HNIs, how critical equity is as a component when you're doing their overall portfolio planning, looking at the current market?
See, for many of the HNIs we deal with, it finally boils down to what their goal and objective is. If there are people who are really looking at equity allocation from a growth perspective, then of course it becomes quite critical. But for many of the families we deal with, they're more looking at wealth preservation, because their risk is really which lies within their businesses. In that case, the equity allocation tends to be a lot smaller, which is there. So I guess the overall quantum of the corpus which is there, as well as the goal, determines really what allocation would an HNI want to make towards equity.
Sure. So, Nilesh, coming back to some of the basic thoughts. Now, given where we are today, what are your preferences in terms of sectors? What are your own preferences? You mentioned small caps might do better. I mean, it's bottom up, I'm guessing, but usually there are themes that have been working in the market. Tire stocks have been doing very well. Gems and jewelry had a bit of a good run in the last couple of weeks, and then there was a little bit of cool off. Coffee prices hitting, I think, 2-year highs. So anything that really stands out in terms of a flavor?
So one, we are seeing certain sectors where there is turbulence, like technology. The commentary of the management themselves is a little bit cautious, and they are all great companies available at good valuation, but they are going into a turbulent weather. Maybe the time to buy them will be later, not today. Then there is
there's telecom, speaking of like turbulent sectors,
where there are big players fighting out for setting up the rules of the game. Now it's maybe these are great time to buy, but I will rather wait and figure out what the rules of games are before making investment. Then there is investment related sector where courtesy the high debt burden, courtesy the delays on execution, and little bit of restriction in terms of availability of financing is all resulting into little bit of slowdown. So my focus will be towards the consumption sector, where I believe because of the good monsoons, the rural economy will support consumption. Because of lower interest rates and easy availability of finance, there will be rapid consumption. The 7th Pay Commission and one rank, one pension payouts will give money in the hands of government pensioners and employees, and they will go and spend. So all these things will push consumption.
So consumption also has so many different parts to it, What part of this consumption basket do you like? For instance, we've had a couple of players in the quick service restaurant category, I'm not getting into names, where concerns came up, where, the question was that is urban consumption growth slowing down or not? Then there is rural consumption, there is the two-wheeler side through which you can perhaps play it. So how to play this consumption story?
So essentially, if you take a call that in 2010, when 6th Pay Commission was given, people would have bought automobiles, and that's available in data. In 6 years' time, they are likely to replace it. So automobiles, auto components, people financing automobiles and auto components are likely to do well. The second thing is related to when you get a lump sum money, probably you will go and buy another house, you will do home improvement. So sectors which are related to this cycle, it could be paint company, furnishing company, cable company, consumer goods company, or it could be cement and cement products company, or it could be housing finance companies providing that finance for home improvement or home
You don't think
purchase.
their valuations are too high? I mean, the market has been in love with housing finance companies for a while. But do you think there's still more value?
I mean, as of today, housing finance as a percentage of our GDP is probably 1/10 of what is there in American market. If I see outside of this mall, which is quite prestigious, there are people staying on the footpath. So they all need home. And we can only give them home through loan rather than through equity.
Okay, so we're going to talk about this. We'll continue the conversation on the other side. Sectoral funds, thematic funds, will they be a big play this year? Should they find a place in your portfolio? And how to decide when there are certain red signs associated with your mutual fund? When should you switch out? Some of those talking points coming up after the break. Welcome back. The Diwali special continues on Money, Money, Money. So, Nilesh, I'm going to go back to the conversation we were just having. You gave a couple of ideas about, pockets which look interesting in the market. Is that going to translate into a lot of thematic fund ideas, perhaps this coming 12 months? Should one be looking at sector funds at all?
Thematic funds are like desserts. It should be consumed only along with your normal meal, and you should not overeat it. So, in a very simple manner, unless until you are an expert in investing, please don't go for thematic funds. They could be high risk, high return.
Ashish, we remember the bloom of the sectoral and thematic funds back in 2007-8, the infrastructure funds, the power funds, and we all know what happened after that. Your thoughts in looking at the current products which are in the market?
So I'm a big proponent of keeping it simple. I mean, allocating it to managers based on styles. Because if you have a portfolio built with managers of different styles, you automatically get diversification across different themes and sectors. But however, for let's say sophisticated ultra HNIs or HNIs who want to spice up their portfolio with some thematic funds, I think it's very important to have a philosophy around your thematic allocation.
Sure.
So if you believe that the thematic allocation needs to be contra in nature, because a lot of times fund managers, need to maintain public track records.
Yeah.
So there are themes or sectors you wouldn't see in diversified equity funds. So something like an IT or a pharma today, which is kind of fallen off the eyes of the investors, and a lot of the pain is already in the price. So if you want a thematic exposure and the philosophy is to have a contra exposure within the theme, then something like an IT and pharma looks quite interesting at this point in time.
But only for the slightly higher risk appetite investors and more sophisticated
It's not
investors.
for the faint-hearted. I mean, it's for the sophisticated investors who don't mind even if the call on the theme goes wrong.
Sure. So now coming to the point of how to gauge your equity portfolio's performance. You gave us the basic benchmarks, Gaurav, a while back, that you're looking at 15-16% annualized over a long time period. But my critical question is this, Nilesh. While we all know that equity is a long-haul story, it's a long-term investment, when do you realize that maybe this fund is not doing what it should to my portfolio? So maybe I need to either talk to my advisor, or if I'm doing it myself, then I need to start thinking of alternatives. When does that point arise?
So there are two ways of taking your profit out or cutting your losses. One, from an asset allocation point of view, if you are too much overweight into a particular asset class, if markets have corrected big time, your equity portion will come down, your fixed income would have gone up. It's time to restore the balance by selling fixed income and buying equity. On the other hand, it could be in relation to your component of your asset allocation. So I invested in equity, but that fund, that stock is not doing well. Now I have to take a fundamental call. One thing we must remember is that form is temporary, but class is permanent. There are always bad days in the life of a stock picker as well as fund manager. But if your fundamentals haven't changed and prices have come down, valuations have become cheaper, it's time to double your bet. It's time to add more rather than cut your losses. It's your ability to buy at lower level, averaging down below, which gives you, better return opportunity. So at the top level, look at the asset allocation. Whenever it is in imbalance, restore it. At the bottom level, look at the components. Whenever the fundamentals change, it's time to book your profit or cut your loss.
Gaurav, what is your thumb rule when you decide that, okay, it's time to now make a change in someone's portfolio? This fund needs to go and I need to maybe replace it with something else.
So what we do is we kind of, internally we keep evaluating funds on weekly basis or something, but we don't change portfolios sometimes even for years. What we start looking at is that when we constructed a portfolio, say if it had some large cap, mid cap, index fund, whatever, first we look at that, is that fund adhering to its philosophy? So if a fund says I'm a large cap fund, there are certain statistical parameters and the benchmark they have given in the document, are they adhering to it? If they are, then we'll still give them time because the benchmark itself is underperformer. Then we look at peers and how's that fund performing. And then at some point of time, we may decide that stop SIP. Does not mean that we take it out. So that's
you just stop further investments.
Stop further investment, stay. And if things are still bad, which means it goes beyond 3 quarters or even a year, that's when we start taking out.
So Pratik, your thoughts as we wind down the equity part of this conversation, what are you advising your clients right now? What sort of equity exposure to take, primarily large cap? Are you looking at some contra ideas, as Ashish just mentioned?
See, when we're constructing the whole equity portfolio, what we do is that we have a strategic allocation. That means for, let's say, a balanced investor, we've got about 60-70% of his allocation which is actually going into a large cap universe. The remaining 20 to 30% is where you could take exposure through whether it's in the mid cap, small cap, or the sectoral space. So it could be a diverse mix of some of these strategies which we could look at. For especially the HNI space, some of the portfolio management schemes which are run with specific mandates also find a role in the 20-30% of the equity exposure which comes in. So in a way we believe that, I do agree with what Gaurav is saying, that you need to be consistent and stick to that mandate which is there. There could be periodic performance, underperformance which does not really dictate your transfer from one fund into the other fund. But largely we would again stick to the well-known performing funds with with a much longer track records.
All right, gentlemen, thank you so much. Now, that's the end of the equity part of this conversation, but we have a lot more to talk about, so keep it with us because this conversation continues next week. We will discuss where else you should be investing beyond equity. Will real estate finally start yielding some returns? Should you have a little bit of gold in your portfolio? What about other asset classes like perhaps art? All that and more will come up next week, so keep it with Money, Money, Money.